Most home buyers, especially first-timers, often wonder what it takes to get approved for a home loan, and it's really quite simple. Qualifying for a mortgage is basically like sitting on a three-legged stool where one leg is your debt-to-income ratio, the second leg is the collateral, meaning the home itself, and the last leg is your credit score. If the stool can hold you up, you can easily get a home loan. However, if one of these legs is broken, you will fall on your butt and get nothing until you fix it. Now, the first leg of the stool, your debt-to-income ratio, will help determine how much home you can afford, as we will review your total gross income and compare it against the debts that are reported in your credit report on top of the new mortgage payment, including principal, interest, taxes, insurance, and HOA fees if they're required. For most mortgage programs, you will need to have a debt ratio at or below 45%. So, for a quick example, if you gross $4,000 per month, you can spend approximately $1,800 per month towards debt. That means if you have a $350 car payment, $100 going towards student loans, and another $75 in minimum credit card payments, you will be able to spend approximately $1,275 per month on your new home. Now, some loan programs will have more strict debt ratios, and others, such as FHA financing, will allow expanded debt ratios in certain circumstances. Now, the next leg of the stool comes down to the property itself and the appraised value. The home must be worth what you have offered to pay for it. A lender-approved, state-licensed appraiser will determine the value of the home. They will inspect the property to determine its square footage, its condition, and the room count in order to find the most recent comparable home sales. These sales will be graded and adjusted to determine the value of the home you're trying to purchase. If the value comes in at the purchase price, you are all set. But if it comes in lower, you will either need to renegotiate with the seller or pay the difference out of pocket. So, for example, if you agreed to pay $175,000 for a home and the appraised value comes in at $170,000, the mortgage terms, such as your down payment and loan amount, will be totally based on the value of $170,000. The additional $5,000 that you agreed to pay will either need to be renegotiated with the seller or you simply pay out of pocket. This happens often in a seller's market due to heavy competition for every home sale. Now, the last leg of the stool is your credit score. It really is the most important because it determines many things when it comes to mortgage financing. First, it will help determine the loan program as well as your interest rate. It also has a bearing on how much you will pay in mortgage insurance if you don't have a 20% down payment. For most mortgages, the top of the mountain for credit score is typically a 760 score, which will provide the most favorable loan terms. Anything above a 760 is great, but it typically won't earn you any additional benefit other than pride or maybe a high five from your neighbor. Now, the next lowest tier is a 740, and the scoring tiers continue in 20-point increments all the way down to 0. However, keep in mind that most lenders won't work with a borrower under a 580 score. If you happen to fall anywhere in between 20-point scoring tiers, you are treated as the next lowest tier. What I mean is that a borrower with a 639 credit score is treated as if they have a 620, even though they are only 1 point away from that 640 tier. This is why every point matters, as the cost and rate for a 620 borrower is much higher than those for a 640 borrower. Check this out. As of this video date, if you are purchasing a $175,000 home using an FHA loan and you have a 640 credit score, your interest rate would be around 3.75%, and the principal and interest payment would be $782. Plus, you would receive an $1,163 lender credit to cover some of your closing costs. Now, if you buy that same home and you had a 639 score, your interest rate would be 3.95 and the payment would be $802 per month. One measly point in credit score could cost you $1,163 out of pocket, as well as an extra $20 every month for the next 30 years. This is why you need to make sure and do everything you can to maximize your credit score prior to getting a mortgage. If you haven't already watched my other videos on how to maximize your credit score, you should do that now, as these short videos could save you thousands going forward. If you'd like to book a free one-on-one home loan consultation, you can do that on our website at michiganmortgagesolutions.com. I hope you find this information useful, and our team really looks forward to helping you get approved for a great mortgage.